paint is drying and the grass is growing in the financial markets today. Not a whole lot of progress made one way or another, but an interesting setup emerging in the lull, giving us a chance to think about perhaps a bit of a change of pace for global financial markets and a change of focus. This is Macro Money. I'm Elias Pivak, head of global macro here at tastylive. And today we are going to focus on a little bit of a deeper conversation than just looking at this or that immediate bit of price action, and instead look at some very important economic data that's coming later in the week, but consider the staging around which it is coming and where the markets have brought us here. Because what seems to be occurring is a sort of cheering for a turn in the business cycle that's starting to perhaps reintroduce this until recently dormant idea that a global recession after a rapid rate hike cycle will ultimately be an inescapable, inevitable outcome. And as the markets start to cheer, and as stocks rebound in the past week and a half or so, the question about why they are rebounding and whether what this reaction reflects is a sort of stale thinking about what is and what isn't a risk-on catalyst starts to take shape. So what we're going to do here is we're going to review a little bit about where we are in the global economy, how we got here on stock markets, and whether it seems like what has been a positive reaction to weak economic data is misplaced because something more sinister is starting to show its face. And then consider some more incoming economic data, this time from China, to consider what might push the markets to recognize that they are in a different kind of world than perhaps they are currently envisioning. We'll start with just a brief look at the performance that we saw from markets last week to quickly anchor ourselves in what has occurred. So we can see here stocks last week rose for a second consecutive week. S&P up 0.5% after a 2.6% rise in the prior week. NASDAQ up nearly 1% after an almost 4% rise in the prior week. Yields coming off. That's after the Fed signaled that they are not putting away a sort of cautiously dovish bias, saying they still are nowhere near wanting to raise rates and leaving the door open for perhaps even cutting them because they think that the recent run of hotter inflation data may be something that works its way out and just needs more time. So the guidance from the Fed sort of on the dovish side of expectations. And then, of course, weak economic data. And all of that pushing back yields, reintroducing some more rate cut expectation and giving stocks a lift. We can see that here. So you'll notice in the green is the Fed's line in the sand. This is where they have the outlook for the year as they've envisioned it. You can see here, it's looking like 75 basis points articulated in December and reinforced in March. But we also see in the gray bars the evolving market expectation around that forecast. And so we can see here that as the markets got to be more hawkish than the Fed, stocks turned lower, worried about the idea that money in the future will be more expensive, and in relative terms, of course, and that what this means is that taking risk now becomes that much more unattractive. Because if you take a risk and lose money, you have to borrow back with more expensive rates. So what you then have is a kind of significant pullback here as you get into last week. And we can see here that this seems to have actually turned the other way. So a few more rate cuts have come back into the forecast. And as we can see, stocks have dutifully moved higher. They've bounced on this. Now, what actually inspired this reaction? Well, we can see here, obviously, first and foremost, the U.S. jobs report on Friday following that more dovish tilted Fed gave us a very kind of clear-cut set of catalysts. So job creation, 175,000 versus 243,000 expected. Unemployment rate higher, pushing into the top of this this 2-year range, 3.9 versus 3.8% expected. This much is, of course, well known at this point. The other side of this was a very worrying ISM report. The service side came out on Friday right alongside the jobs report, and it was shockingly weak. We can see here the service sector has really been the essence of growth in the U.S. economy. It is, of course, the largest component of U.S. economic activity and of GDP. Close to 70% of the economy is the service sector. And we can see here that while manufacturing had been anemic essentially since the middle of 2022, services have been the driver of relatively well-supported economic activity. Well, the expectation was that we'd get another month of the same at about 52. This is, of course, in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. We got contraction in the service sector. Wild miss relative to expectations. 49.4 versus 52 expected. So the service sector and the manufacturing sector, manufacturing numbers were published earlier last week. The manufacturing and the service sector shrinking together for the first time since back here, since late 2022, December, to be precise. So a very significant downturn here in what is the growth engine of the economy. And the internals of the report, not particularly encouraging either. Downturn in new orders in both services and manufacturing. In services, they're still growing, but at the lowest rate that we've seen in almost a year and a half. And in manufacturing, new orders contracting. Employment outright shrinking in both, and in the service sector, shrinking at an accelerating rate. Both of these we can see below 50, but at least whereas in manufacturing, the pace seems to be moderating, in services, the much bigger employer, it's accelerating. And at the same time, the prices side of things seemingly going the wrong way. The price components accelerating in their growth, not what obviously appears to engender the good part of the business cycle. Now, of course, people have been throwing out the stagflation word. It is entirely too early to make that kind of a call, but it is certainly not encouraging if new orders are going down, employment is shrinking, but prices are going up. This is not what you'd want to see. As it happens, these outcomes follow in a sequence that has been with us essentially since the middle of April. So we've obviously been tracking this index religiously. This is the Citigroup Economic Surprise Index, and the assertion that we've made here is that when you put the 20-day moving average on there, which is about a month average, 5 pieces of data for a week, 4 weeks in a month, that's about 20. So you're looking here at this moving average, and it seems to be that when you cross it, there tends to be follow through. And so when you get through it, the index seems to extend. So, for example, we can see here from the peak in March of 2023, there's a break through, and then we follow in for about a month and a half. And U.S. economic data is tending to deteriorate relative to forecasts with all of what that implies. We can see similar things when we break to the upside here or to the downside here or here or here or here. And so what we have been looking at essentially since the middle of last month has been an increasingly accelerating deterioration in U.S. economic data outcomes. Now, of course, the markets have read the most recent version of this with cheers. We can see that right here. I said, oh, good. We've gone from 23 basis points to 36. We're still quite a bit more hawkish than the Fed baseline, but at least the Fed seems to be endorsing some of this. So maybe they raise the baseline when we move into the June meeting, and it'll be one of those times that the Fed makes a revision once a quarter. But what we see here is clearly more cuts in the face of weak data are being greeted by markets. They're enjoying this. But what does this actually mean? Well, the global economy hinges quite a bit on there being a strong US. And at the moment, there isn't really very much of an alternative. In fact, the US has already stood up for about a year and a half as one of the few areas of global growth where there is some resilience. The euro area is finally starting to find its footing a bit, but it's spent most of last year in contraction mode. China has been woefully unable to get up off the mat after reopening belatedly from COVID lockdowns. And we'll take a look in just a minute just how much weakness there is there. But the US had been relatively resilient. Those three economies together make up 50% of global GDP growth. And that's an understatement considering much of the other 50% depend on demand from the former three. They're essentially vendor economies that need for there to be buying from the large three in order for them to have demand and growth. Just think of Canada or Mexico with the US, or Southeast Asia and some Latin America and Africa for China, or Central Europe or Nordic Europe for the Eurozone. And so what we're looking at here is a situation where two legs of the stool were already effectively out. The European one is perhaps getting mended here a bit. But if the US one is snapping finally, if the cumulative cost of tightening is finally catching up, this seems hardly good news for risk appetite. As it happens, if we look at the way that global economic data has been performing, this is not a US phenomenon. It's a much broader one. We can see all of this extending out. Not surprisingly, we just talked about vendor economies. We can see the downturn in emerging markets where those vendor economies tend to live. That's a little bit belated relative to a downturn on the G10 side, where the US and the euro area is rolling over. But we can see the global index itself has been starting to unravel here in recent weeks. And if we were to look at a catch-all of global PMIs, we can already see the manufacturing side is telegraphing that in April, things turned in the wrong direction. We'll see how that gets confirmed later this week as we get finalized service sector and composite numbers. But it may be that indeed April marked a turn in the global business cycle, sort of like October marked a turn in the global business cycle last year, where there was a slowdown, things anchored, and then both sectors, manufacturing and services, started to improve. Looking at how data has been performing relative to expectations here, and considering what we might then get on this part of the equation, it could be that we are once again looking at a coordinated turn in the opposite direction. And a weakening in the US would certainly be a potent catalyst. This, of course, raises an important question. Do stocks make sense when they cheer for weak US economic data? Or have we gotten to a place where, because the Fed has kind of anchored expectations, because we're not going to know very much about its intentions until we see another meeting in June and the actual baseline for Fed rates from their own official forecast is revised or not revised? We'll see. But because the relative cost of money conversation has something of a pin in it for now, at least perhaps until we get US CPI data next week, the question then becomes, well, we rallied because the economy was doing okay and there was going to be a lot of rate cuts. Then we stopped that rally once the rate cut situation started to look less supportive. We can see that right here. And maybe the rate cut situation is being more supportive here, but maybe that's for the wrong reasons. Because finally, the US business cycle is turning. As we can see here, much of this rally has come on the basis that the Fed is wrong since the beginning of this year, or at least the expectation in markets that the Fed is wrong. The core move here, we can see the Fed signals in November to build out rate cuts because it's done hiking. It says that. Risk adjusts, and we stall at the turn of the year. And much of the rest of the move occurs because the markets first think that the Fed is going to have to cut a lot more than they're saying, and so risk on. And then that the Fed is going to have to cut a lot less than the Fed is saying, and so risk off. But what if the Fed's right? And what if we adjust this way, but not for the kinds of reasons that the markets perhaps were hoping here, as the economy was doing fine, but for adverse reasons, because the global economy is turning? That would not be very good news at all. And to that end, we look at the release of Chinese import and export data later this week as a barometer on just how weak the global economy looks outside of the US at a time when the US itself seems to be turning. The expectation here is we'll barely claw back into growth for exports and for imports, but well within this digestive range here that follows a long period. It's a bit cut off here, as a matter of fact, of parallel decline, loss of external demand and weakening domestic demand, imports and exports cooling in tandem. Over the weekend, we're going to get inflation data where headline CPI is expected to continue to hug zero, second consecutive month at 0.1%, whereas wholesale inflation continues to shrink, albeit at a slightly slower rate, 2.3% year on year. But all of this, of course, speaks to tremendous weakness. Because if an economy is robust, if demand is robust, prices go up because people are competing on price for scarce resources. People want to be buyers of things. This is the opposite. This is an absence of demand. There's not enough buyers of things, and so things are going on discount. Prices are not growing, or on the wholesale side, actually still shrinking. As it happens, China's economic surprise index has been turning lower alongside with what we just saw at the global level, the emerging market level, the G10 level, more broadly. And so it seems like there's, with these inflation and trade numbers, risk that there is actually weaker outcomes than expected, because this seems to be rounding something of a top. And so these numbers might actually be still scarier from a global growth perspective, which would be in line with what we've just seen in the latest set of official Chinese PMI numbers. We can see for April a significant turn lower after several months of improvement for both manufacturing and services. Now, in fairness, manufacturing has been a bit anemic around the 50 level, but services was enjoying quite the upswing here in China in the fourth quarter of last year and going into the beginning of this year. And April seemed to mark a stark adjustment back lower. And that's perhaps not surprising. Well, what we can see here is since the beginning of 2023, per capita consumption has outpaced income in China, which is obviously not a sustainable kind of thing, especially in an economy without the kind of highly evolved credit markets that we often see in developed economies. Now, we can see here, historically, these two hug very closely together. Then, of course, we have the pandemic when expenditures collapse much more than income does because the economy goes on lockdown. People are stuck at home. They're not spending. There is a kind of correction and redigesting as the economy reopens. That's right here. And we can see since then, income is stagnant. And consumption expenditure has overshot it, but an unhealthy gap has evolved, which is a kind of headwind for economic growth. We can see that here in the most recent GDP numbers. We saw the fourth consecutive quarter that real GDP is outpacing nominal GDP, implying that there is a deflationary gap here of almost 1.7, about 1.5 to 1.7 on average GDP percentage points, GDP growth percentage points. So this is an economy without demand. If this is the environment in which the U.S. economy is slowing and the Eurozone remains relatively weak, and we get data this week that underpins the idea that actually situation in China remains anemic, well, then global growth might well be starting to turn in an adverse direction all around. And while that may give a little bit of hope to those wanting rate cuts, it seems hardly like the kind of thing that is likely to be cheered by markets for very long, because the implications are that those cuts are coming to address something much more worrying than just the last bit of inflation proving less sticky than perhaps some fear. And that is Macro Money for today. Thanks very much for joining. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what that might mean. I'm on with Chris again for Futures Power Hour on Fridays, on with Victor Jones for the Price of Truth on Wednesdays, on with Victor again, along with Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.